Hello traders, and welcome back to the channel. Ever feel like you're trading against a tidal wave? You've done all your technical analysis, the fundamentals look solid, but the market just keeps moving against you. What if I told you there's a third, crucial piece to the puzzle? Today, we're diving deep into one of the most powerful, yet often overlooked, tools in a trader's arsenal: market sentiment analysis. This isn't about gut feelings or guesswork. It's about understanding the collective mood of the market. By the end of this video, you'll know exactly what market sentiment is, how to measure it, and how to use it to make smarter, more confident trading decisions. So grab a notebook, because you're not going to want to miss this. First things first, what exactly is market sentiment? In simple terms, it's the overall attitude or feeling of investors towards a particular market or asset. Is the crowd feeling bullish and optimistic, ready to buy? Or are they bearish and fearful, looking to sell off their positions? Think of it as the market's collective psychology. When sentiment is overwhelmingly positive, you often see prices being pushed up, sometimes beyond their fundamental value, creating what we call a risk-on environment. Conversely, when fear takes over, a risk-off environment emerges, and investors flock to safer assets, causing prices of riskier ones to drop. Understanding this emotional current is key, because markets don't just move on numbers. They move on human emotion. Greed and fear are powerful drivers, and sentiment analysis helps us track them. So, how do we actually measure something as intangible as feeling? It's more scientific than you might think. There are several popular sentiment indicators that traders use. One of the most famous is the CBOE Volatility Index, or the VIX, often called the Fear Index. When the VIX is high, it means traders are expecting a lot of volatility, which usually signals fear and uncertainty in the market. When the VIX is low, it suggests complacency and low fear. Another great tool is the put-call ratio. This ratio compares the number of traded put options baits that the price will fall to call options, which are baits that the price will rise. A high ratio suggests bearish sentiment, while a low ratio indicates bullishness. There are also surveys, like the American Association of Individual Investors AII Sentiment Survey, which directly asks investors if they're bullish, bearish, or neutral. Combining these indicators gives you a multifaceted view of the market's mood. Now, let's get practical. How do you integrate sentiment analysis into your actual trading strategy? It is important to remember that sentiment is best used as a confirmation tool or a contrarian indicator, not as a standalone signal. For example, let's say your technical analysis suggests a stock is overbought and due for a correction. If you then look at sentiment indicators and see extreme bullishness, everyone is euphoric and piling in, that could be the confirmation you need. This extreme optimism often precedes a market top. This is the heart of contrarian trading. When everyone is greedy, be fearful. Conversely, when sentiment is at rock bottom, with extreme fear and panic selling, what Warren Buffett famously called blood in the streets, it can often signal a market bottom and a prime buying opportunity. You use sentiment to identify these points of emotional extremity where the crowd is likely wrong. Let's walk through a hypothetical trade. Imagine you're watching a popular tech stock. Your charts show it's approaching a major resistance level. You then check the news and social media, and the hype is off the charts. Everyone is talking about how this stock can only go up. You check the put-call ratio, and it's at a historic low, meaning very few people are betting against it. This is a classic case of extreme bullish sentiment. As a contrarian trader using sentiment analysis, you wouldn't jump on the bandwagon. Instead, you'd see this as a warning sign. The extreme optimism suggests the good news is already priced in, and the stock is vulnerable to a pullback. You might decide to wait for a price drop, or, if you're an advanced trader, even consider a short position, using that resistance level as your guide. You're using the crowd's emotion as a signal to do the opposite. However, a word of caution is essential. Sentiment analysis is not a crystal ball. The market can remain irrational longer than you can remain solvent. A market with bullish sentiment can continue to get even more bullish for a long time before it reverses. That's why you should never, ever trade on sentiment alone. It must be combined with your other analysis methods. Think of it like a three-legged stool. You need technical analysis to tell you about price action, and levels fundamental analysis to tell you about the asset's intrinsic value, and sentiment analysis to tell you how the crowd is positioned. When all three align, your trade has a much higher probability of success. For example, if a fundamentally strong company is sold off heavily during a period of market-wide panic, extreme bearish sentiment, and is now sitting at a major technical support level, that's a powerful combination for a potential long trade. Beyond traditional indicators, the modern digital age has given us a new frontier for sentiment analysis: social media and news analytics. There are now sophisticated tools that scan millions of tweets, news articles, and forum posts every day to gauge the public mood towards a specific asset. These platforms use natural language processing to identify whether the language being used is positive, negative, or neutral. Is the chatter around Bitcoin suddenly filled with fearful words? Or is a particular stock trending on Twitter with overwhelmingly positive comments? This real-time data can give you an edge, helping you spot shifts in sentiment as they happen, often before they're reflected in traditional indicators. While some of these tools can be costly, there are many free resources that track social media mentions and news sentiment, giving you a glimpse into this powerful data source. So, let's recap the key takeaways. Market sentiment is the collective emotion of the market, a powerful force driven by greed and fear. We can measure it using indicators like the VIX and the put-call ratio, as well as by analyzing news and social media. The most effective way to use sentiment is often as a contrarian indicator, buying when others are fearful and selling when others are greedy. But remember, it's a piece of the puzzle, not the whole picture. Always use it in conjunction with your technical and fundamental analysis to confirm your trade ideas and manage your risk. Ignoring the market's mood is like trying to sail without checking the winds and the tides. By learning to read the emotional climate, you add a profound new dimension to your trading, helping you navigate the markets with greater insight and confidence. Thank you so much for joining me today to explore the fascinating world of market sentiment. I hope this gives you a new tool to add to your trading toolkit. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to hit that subscribe button and ring the bell so you won't miss our next deep dive into trading strategies. What are your favorite sentiment indicators? Let me know in the comments below. Stay sharp, trade smart, and I'll see you in the next video.